Hi there, I'm Jennifer Lee, Senior Economist at BMO Capital Markets. Uncertainty, volatility, panic, all words to describe financial market behavior as the summer draws to a close. All this was heightened by China's yuan devaluation in early August. So this brings into question a lot of forecasts, and it makes our job as forecasters that much more difficult. And it also makes the job of central bankers even that much more difficult, particularly if your last name happens to be Yellen or Poloz. So let's just look at the Bank of Canada and the Federal Reserve. The U.S. In particular first. Has anything really changed fundamentally in the U.S. over the past month? I'm going to say no. Actually, the economy has been growing. The real GDP rose 2.3% annualized in the second quarter, and that number was probably north of 3% by the time revisions get added on. Auto sales were at their second highest in a decade. Home sales are the highest in 8 years. Consumer confidence, second highest level in 7 or 8 years. Capital spending is finally turning around over the past couple of months, and even net exports added to the bottom line for the first time in 3 quarters. And let's not forget jobs. We've added over 240,000 jobs in the past 12 months alone, on average per month, and the jobless rate is at a 7.5-year low. So those are all reasons why the Fed should lift rates from emergency low levels before the end of the year. However, the Federal Reserve, they're faced with a lot of global financial market volatility, and if that persists, that could have ramifications on the U.S. outlook. And there's the fact that inflation remains quite low, and the Fed is dealing with this powerful combination of weak energy prices and a strong U.S. dollar, which they do think it's transitory. However, those are the sort of factors that are going to keep the Fed from raising rates too rapidly, not that anybody thought that they were going to in the first place. We continue to look for a rate hike before the end of the year, whether it's September or even October, or some people are even thinking December. We do believe it's going to happen before the end of the year, but the rate of normalization will be gradual and it will be very slow. What does this mean for the Bank of Canada? Well, the bank, let's see, they're faced with a negative first half for the economy. Oil prices are still south of $40, and you've got a Fed that's very reluctant to move too quickly. So given that backdrop, the Bank of Canada is probably going to be sidelined for the rest of this year and next. There are lots of compelling reasons why they shouldn't cut rates, although that's there's some talk about the bank cutting rates these days. The reasons why they shouldn't cut rates, let's see, interest rates are already near record lows. Canadian dollar has already been hammered. Household debt is still quite high. The housing market is still quite hot, particularly in Toronto and Vancouver. And exports are finally starting to turn around, at least they did in June. But there are also reasons why they could also cut rates, and that's if oil prices do not pick up from these very low levels, and if exports actually slip again in July. And those are reasons why the Bank of Canada could potentially cut rates before the end of the year. So bottom line is whether the Federal Reserve is going to raise rates sometime this year, and whether the fact that the Bank of Canada is going to be sidelined for the rest of this year and next, rates will remain low for longer. That's something we've been saying all year, and that's probably something we're going to continue to say as the new year rolls around. Thank you.